Good afternoon. Thank you all for joining us today for our webinar on turning senior living options and expenses into a financial benefit. Up on the screen are our disclaimers. I'll leave them there for just a moment, and then I'm going to introduce you to our speakers today. Today speaking are Leila Orndorff and Dwayne Wernicke, both from Canterbury, Westminster. To give you just a little bit of background before I introduce the speakers, I want to introduce why Westminster Canterbury is speaking with us today. One of my clients, James and Marg Anderson, recently became residents here at this facility, and so they brought to my attention how much they loved the transition that they were going through in one of our annual reviews, where we also did some more advanced planning in order to take advantage of large deductions that occurred as a result of this transition in their life. Just for everyone's benefit, I have as a resource a document that was put together by James and Mark on their journey, their experience, sort of what they went through and what they learned about this experience. They've asked me to make sure that it's available for anyone who asks for it, who's considering going through this phase of their life and investigating something similar to what we're going to discuss today. So if you need that, make sure you email me or any advisor in the office that you're working with, and we'll be sure to get you a copy of that. Also, before we begin, I want to make a comment about Q&A. We are going to be taking questions at the end of our presentation, so I want to make sure that you have an email address with which to communicate to us any questions you have during this presentation, and you can submit those questions at any time, and we'll hold them for the end. The email address that you want to submit those to is AGUISE, that's AGUISE, at ebwllc.com. Once again, it's AGUIESE at ebwllc.com. That's April's email address for those who know April. And let me begin now by introducing our speakers. For those of you who don't know, I'm Brian Beatty. I'm one of the partners here at Eganberger & Weiner. I'm not going to go over my bio. Hopefully you know who I am. But I will go over Leila and Dwayne's. Leila served as a sales counselor for Shenandoah Valley, Westminster since 2011. Prior to being there, she worked as a personal banker and administrative assistant for a local bank. And she managed her family's restaurant for a time before that. An English major from Lynchburg. Her roles at SVWC is that she speaks and meets with prospective residents who are considering moving to a continuing care community and providing them with the information and facts needed to make that decision. And she lives with her husband and 2 young daughters in Strasburg, Virginia. Dwayne, he's Chief Financial Officer for Shenandoah Valley, Westminster, Canterbury, and he joined in 2012. Dwayne's worked in healthcare since '97, first as a consultant and then later as an administrator for a physicians group, and then Chief Operating Officer of an actual medical practice in Northwest Virginia. He's a CPA, and he has an accounting major from George Mason University and a BS in airway science. That's interesting. From Ohio University. Does that mean you were going to be an air traffic controller, Dwayne?
Possibly air traffic controller, but mainly was looking more towards piloting.
Oh, interesting. Well, great. Well, I'm going to turn it over right now to Leila and Dwayne, and I will pick it up a little while later.
Excellent. Brian, thank you so much. I want to thank you and Carmen and your whole practice there for allowing us to present today, to really provide some information that I hope is going to be very helpful for those of you listening that may currently be in planning phases for retirement living options, maybe looking toward the future. Maybe it's even a loved one that might be looking at some considerations for retirement living. So we want to kind of branch into what those options could look like, some of which may be a bit more specific to us at Westminster Canterbury, but ultimately are still choices in the entire industry. If you have already researched retirement communities or different facilities for types of care, the cost that it is associated, you may well have found that it is not apples to apples. And so I think being fueled with some information as you go through a potential process for that is really going to be helpful, so you know the right questions to ask, and you know maybe what the offerings are from one place to the next. We hear it often, and we try to relay this as a great message, and that's probably why you're listening today, but it's much better to be proactive than reactive, and so we think this is a great opportunity to learn about some of those resources and some of the choices you may be facing. And we also thank Jim and Margaret Anderson as well, because they're wonderful residents here in the community. I had the pleasure of working with them and the connection here as well today. So thank you all if you're listening. I think you are. One of the things actually that Jim mentioned to me directly recently was also in considering these options, first and foremost, is really thinking where you want to live. Where is it in your planning that you really want to be located? And that might be a jumping off point, a good starting point to think about what's important to you in the area that you plan to live. And then from there, look at some of the considerations I'm going to go over. So on this page you're seeing right now, just a brief snapshot about some things that are associated with Westminster Canterbury. We are a not-for-profit community, certainly something as you do research into other areas and other communities to look for. This is really in our mission something that is important, but also the opportunity for us to really be mission driven and always having an ever-present goal of providing quality care, quality of life, and allowing residents to really live their lives here with dignity. So that statement is so important to us. A few other little points that you can see bulleted there, some exciting things. We're celebrating our 30th anniversary. Always a great question to ask a community you may be considering. How long have you been in business? Something to look into. There may be church affiliations. There are a lot of different ways that communities are run, or maybe their founding base comes from. Ours is particularly through the Presbyterian and Episcopal churches. A couple of other good points there. Something that you should potentially look for is that community accredited? CARF CCAC is an accreditation authority for rehab facilities and continuing care communities, and they do a pretty rigorous inspection of communities every 5 years for those that seek this accreditation. So we've been reaccredited now for over 20 years, which is exciting, but certainly worth looking into because there's a small percentage of continuing care communities that actually do earn this distinction. Other points of interest, as a not-for-profit, we also have a great partnership with a lot of community organizations. And what that means to our residents is that we as a community are also giving back to the greater community. And there's some wonderful volunteer opportunities that they may have to give back as well through service or other means. So just a few things to kind of give you, again, a snapshot about us or things you might be looking into when you research other areas. And I will move forward next. Apologize if there's a little bit of a lag time on the screen change. Let's see. Brian, if you wouldn't mind, thank you. I was going to have you scroll. I appreciate that. I want to jump into next what kind of figures, what cost may look like when you're really looking at long-term care. And just to give you an idea, if you're not that familiar with long-term care in the industry, when we talk about long-term care, we're really looking at nursing home care. However, there are different facets of long-term care that include assisted living and memory support. But in this particular instance, when I go over some figures here, it's really looking at nursing home care in whatever form that really comes out to be, whether it's in a standalone facility or otherwise. Want to read just that first sentence. We actually found an article from the U.S. Department of Health and Human Services just this past year that states more than 70% of Americans over the age of 65 will need long-term care services at some point in their lives. Now that's a big percentage. I think we all probably hope that we don't, but it's a risk you have to think about, that it could be something you may only need in the short term after a surgery. Maybe it's 2 to 6 weeks, but for many people, it can be 2 to 6+ years. So recognizing that this is something that could happen to any of us, the need could arise at any point in our lives, and then also the cost associated with that type of care is really going to be important on the front end here to be able to understand going into it what you're spending on that. So Genworth provides long-term care insurance, but they also have a cost of care study they provide each year. You can actually go on the Genworth website and pull up a cost of care study. We found it's been helpful just looking in terms of average cost in the nation. So in 2016, the average cost of long-term care, and I may either be dealing with a lag again, or Brian may need you to scroll for me if possible, because this will bring up some numbers here. So you can see that nationwide, you're looking at an average cost for nursing care, again, for long-term care, of about $253 a day, knocking on $8,000 a month. And if you look at the second bullet point, you can see it's knocking on $100,000 a year. What they've also provided is a projected cost in nearly 10 years at $340 a day. So now you're looking at about $125,000 a year. Something I point out, though, is to consider the cost in your current area, because potentially if you are in the DC metro area or in the Northeast or really any urban location, the cost of long-term care now is probably already what that projected cost is on an average. So rates around here are already over $300 a day in the Winchester market. So I really encourage you to consider how expensive long-term care is, and with that, what your choices are going to be for how the care is provided and how you pay for it. So this just hopefully sets a bit of a benchmark for you to understand a little bit more about the cost and the process of paying for the cost of that care. So we'll scroll to the next page. I think I'm going to have Brian have you scroll for me each time. I'm not sure of why the glitch came through, but we'll make it work. Hold tight with us for just a minute. We'll get there.
I'm going to need Doug to do that. There you go. Okay.
There we go. Thank you. Thank you. All right. So I'm going to get into some of your options. Things you might be considering, things you may have already talked about, things you may not even have thought about or considered as well. A lot of people want to stay in their home, age in place. You know, the old adage of home is where the heart is very important to many of us who may have lived there 20, 30, 50 years. And so it's a sense of comfort. However, if you start to consider down the road what implications come along with living in your home, those challenges and the cost of those challenges could become more than you had anticipated. So there may be modifications. You may have to put a ramp in to get into your house. You may have to have a stair lift chair. You may need to arrange for grab bars, and some may be expensive items and some may not. The other component is that maybe you're considering an in-home care agency to come and take care of potential needs you may have. It may be bathing and dressing. Maybe you need someone to set up your medications. Maybe you simply need someone to come into the home and prepare a few meals for you for the week and do your grocery shopping. So those are costs that are all going to vary, but considerations of out-of-pocket expense you have to think through. When it comes to the actual in-home care agency providing support for assisted needs or even medication control and management, you could be looking at a very expensive potential option, sometimes more than even what a long-term care setting, standalone setting would cost. We surveyed some local agencies here, a registered nurse to be able to come in and provide certain meds and also have that support on a 12 to 24 hour basis. It was upwards of $500+ a day. So just thinking through that cost is important, and knowing what the local market where you're considering is going to cost you as well. The other big component of that is care coordination. Who is going to coordinate that care for you? Will it be yourself? Will you still be capable of doing so? Will it maybe be a family member, if they're available, or a loved one that if they're near or can do so? Who's going to make sure that the company entering your home is vetted and licensed, and that you can feel safe and trust that they're in your home? Just big things to kind of keep in your back pocket as you consider this as an option. The next little bullet point, we get a giggle out of this because a lot of people think that they're going to move back in with family members. They raised their kids, took care of them for so long, now it's time for the role reversal. Well, understanding that everybody is at a different place in their life, this could pose a big challenge as well. It may shift family dynamics. Children or loved ones may be in the heart of their careers. They may have children at home themselves. So there are a lot of components of that consideration to think through. And it still does not come without cost should an in-home care agency be needed and so forth. So that can be relatively expensive also. Independent living, there's some options in independent living, most of which come through as Westminster Canterbury is a continuing care community, which I'll describe in a bit more detail soon. But there are standalone communities like, say, a 55+ community. Generally standalone homes. You may have access to some great amenities and lawn care and such, but those typically do not provide any type of future care, any health care, any type of options regarding long-term care. So that's still your responsibility. And typically, because you're owning that home, you have to deal with the coordination of resale, or your estate or family members would have to deal with the resale of that property at a later date. Next, there is assisted living. There are standalone assisted living communities that provide help with activities of daily living. Generally, you would see they provide help with 1 to 2, up to maybe 3 or 4 activities of daily living. That means things like bathing and dressing, medication management, general ambulation, getting around, help with those types of needed support systems, meals, things like that. Memory care, you're getting much more specifically into locations that help those that are battling Alzheimer's or different forms of dementia. That dementia comes in so many vast forms, and it's a really challenging process. Each individual is going to be different in their disease process, and those communities are often a much tighter system to protect the residents in case they wander or things of that nature. There again, you're dealing with similar cost structure of the long-term care model that I presented a minute ago. Healthcare, the last bullet point there, is really nursing home care. So that's round-the-clock nursing home care, whether it be a temporary skilled stay after a fall or a surgery, or whether it be a full-time long-term care need for as long as the resident or patient would need those nursing services. And those last 4 bullet points come both in individual settings as well as within a single setting like here, considered as a continuing care retirement community. If you could switch to the next page, I'll go into some detail about that as well. Oh, there's one of the children popped up again. So when you're looking at continuing care retirement communities, as I mentioned before, this is not apples to apples, but there's a general model that you're going to see most often. And what that looks like is generally an entrance fee, a one-time lump sum payment that you're paying upfront, and then you continue paying monthly payments to the community for living expenses and amenities and things of that nature. Within that setting, you will likely find some type of independent living setting, whether it's apartments or cottages or villas, etc. You will likely also find assisted living with memory care or memory support, whether that be coming into the apartment or in a separate setting on that campus. And then the health center, again, nursing home care, so nursing care availability in a single setting or at a single campus. So that's just a snapshot of what the CCRC models typically look like. I'll have you switch pages again for me and go into some contract choices as well. So when you get into the continuing care retirement community world, you're facing some different financial contracts, and I've broken out the main offerings that you may find. And these contracts will vary from one community to the next. They may offer a variety of any of these as well. At Westminster Canterbury, we have a Type A and a Type B. We do not offer a strictly fee-for-service or the rental or equity. But that's a great question to ask when you are visiting communities or calling to inquire, what type of financial contract do you offer? And then recognizing within that contract what the cost structure is. How is that payment structure based for your long-term care services for the future? Type A contract, which we call life care, or you'll see as a life care contract. In a nutshell, the entrance fee is really prepaying the cost of any of your long-term care services at that community. And when we say it's prepaying, what happens is your monthly fee is going to be essentially static across the continuum. So you're paying in advance for the care that you would likely need. Again, 70% or more of people generally do. You're able to pay in advance so that you can plan for the rest of your life what the cost is going to be for that care. So again, the monthly fee will remain static through the continuum. Minor increases may come via inflation or a meal charge, and those are questions to certainly ask of your community. The bullet point at the bottom of that really sums it up. You're assuming the least amount of risk as the resident. The community is taking on the risk of that healthcare cost because you're paying a set fee for it in advance. The notation about the tax deduction benefit, I'll defer to Dwayne here momentarily to go through, but that's something that I think will be very important for you all to hear about and understand a bit more. Type B, a modified contract, generally offers the same services and amenities as a Type A. However, when a resident transitions through the continuum after a grace period, or it may even sound like an elimination period, the monthly fee they pay within independent living will escalate to a market rate for the service being provided. So they're paying less upfront on an entrance fee, but those rates will escalate or even skyrocket at the point of needing long-term care in that community. Often people have long-term care insurance. It's a great offset for those higher rates, but to be honest, most policies that we see still don't quite cover the full daily market rates that we're seeing now. So there's a deficit that comes out of pocket to also consider. I will note in our community, long-term care insurance policyholders can still reap the benefit of their policy even under the Type A life care contract. So it comes as a direct reimbursement to them. Just briefly, the Type C contract is fee for service. That's really as it states. Normally you are still paying an entrance fee, though it may be lower than a Type A. Your monthly fees may also be lower, but you will have an immediate escalation for any services that are provided to you from that community. Often there may also be cost, more of an a la carte feel for amenities or other programs at their campus or at their community. So those are really important questions when you're asking about the contracts. What are the market rates here at this community? What else am I going to be responsible for paying for? So it's helpful to have this information in advance so you know the questions to ask about the cost. The last bullet point talks a bit about rental and equity models, which there are communities out there that offer this. A rental really, as it states, you're just paying a rental fee to live there. Most often that means you're not guaranteed anything. If there is not a healthcare bed and if there's not other options available because residents otherwise have that space, you likely will not be able to stay within the community. And pardon me, I'm just making a quick adjustment on my screen. And Doug, if you wouldn't mind, I've lost that single page. I'm actually not able to view that on my screen at the moment.
Give me a moment here. Sorry for the technical difficulties.
Not a problem. As you work on that, I'll just kind of go into the equity model as well. Equity is really, as it states, you're actually purchasing, maybe a particular home, cottage, apartment. For some, that's important that they know there's some recoup of money if they're able to resell that particular space. But you're still dealing, again, with that responsibility later, where it may befall your family members or a representative for you after you've passed away. You're really assuming all of the risk at this point for these particular options. And again, we don't offer this as options here at SVWC. Another question that I don't have listed on the screen but think is important, when you go out to communities or make these calls, if you're considering these options, even when there's not an equity model, more often than not, there's still some refundability built into those entrance fees. It may be termed over a short period of time, and it declines or amortizes over a certain window. It also may be a refund that is unended. You could have it for your estate, but you're paying a premium on some of those rates. So a good question to ask at those communities is, what does your refund policy look like? Will there be money available back to my estate when I pass away, or how would that work? I'll go ahead and have you flip over to the next page. And maybe I have control now. There we go. I want to turn it over now to Dwayne Wernicke, who is our CFO. And he's going to jump backwards a bit where I mentioned the tax deduction benefit and go into more detail about this for you.
Thank you, Leela. And as you mentioned, there is some income tax benefit to these different plans, most notably the life care contract and the modified care contract. And because of the tax implications, I apologize, I'm going to get into the weeds a little bit, but if you all hang with me, we will get through to a practical matter of how it can be applied. But I do want to just mention a disclaimer very quickly, and I know it was presented earlier. However, as you can see at the bottom of the slide there, Westminster Canterbury does not offer advice on tax preparation. I have not prepared income taxes other than my own for probably now 10, 15 years. So we strongly recommend that any information given during this presentation, you seek, you consult your tax or financial advisor regarding the application of this information and how it meets or is addressed by your specific circumstances. So as mentioned earlier, the two types of contracts that are typically able to receive favorable tax treatment are the life care contract, which is a type A contract as known in the industry, and the type B modified contract. Each are priced in a way that allows residents to prepay for future medical expenses, as discussed earlier. In return, as the residents age through the care continuum, their monthly fee under the type A contract does not increase, despite receiving higher levels of care when needed. Both the entrance fee and the monthly maintenance fee contains a certain percentage that is attributable to future care in assisted living and or health care. I apologize. Here's where we're going to get into the weeds a little bit, so you all bring your sickles with you. But Section 213 of the United States Internal Revenue Code allows for the deductibility of the entrance fee and the monthly fee in the year paid that is calculated to be towards future medical care costs. However, and this is on the slide 8 there, you'll see right there in the middle, no private letter ruling has been requested from the Internal Revenue Service regarding the deductibility of or the amount of allowable deductions, and no methodology for determining the deductible amount has been sanctioned or set forth by the Internal Revenue Service. The Internal Revenue Service has repeatedly stated that this is a question of fact subject to review by the District Director of Internal Revenue. Therefore, the amounts claimed as deductions may be challenged by the Internal Revenue Service. Again, however, revenue Revenue Ruling 76-481, clarified by Revenue Ruling 9372, approves the deductibility in the year paid under Section 213 of the Internal Revenue Code of a portion of the monthly fee paid by individuals in connection with obtaining lifetime care at a retirement facility that is properly allocable to medical care, to the extent not compensated for by insurance or otherwise. These rulings contemplate the consumption and communication of the amounts attributable to medical expenses to residents by the administration of the facility. Again, it's very important to note that no methodology for determining the deductible amount has been sanctioned or set forth by the IRS. Since the IRS has not offered advice towards determining the deductible amount, the most common methods I have seen in the industry are the percentage method and the weighted average method.
Switch over. Oh, we'll head back one more slide there, pardon me.
While we're moving back a slide, the percentage method is determined by the ratio, the numerator of which are all expenses allocable to medical care for life care residents of the facility during the year. The denominator utilized in determining the ratio is the total costs associated with life care residents in the facility, so all costs in the facility. So again, practicality, it's just the numerator is the portion that's allocable to all medical care expenses. The denominator is all expenses for all expenses for the entire facility. Medical expenses include, among other items, insurance and depreciation that are allocable to the medical care facility, but it does not include any amounts attributable to construction of those healthcare facilities. As you can see here on slide 9, for 2016, Westminster Canterbury, it was determined that 42% of a new resident's entrance fee or portion thereof paid in 2016 may/could be claimed as a medical deduction. Additionally, 42% of a resident's monthly fee could also be included as a medical deduction. So as a practical example, let's suggest that in 2016, Mr. and Mrs. Smith entered Westminster Canterbury on July 1st, and their entrance fee was $570,000. Their monthly fee is $4,700 a month combined. For the 6 months that they were residents in 2016, $4,700 per month calculates out to be $28,200. Using the percentage method, or 42%, Mr. and Mrs. Smith could claim 42% of their entry fee, again, $570,000, which calculates out to be $239,400, and that's just the entry fee. The percentage of their combined monthly fee, the $28,200, 42% of that number is $11,844. So 42% of their entry fee, 42% of their monthly fee calculates to a total deduction listed on line 1 of their Schedule A to Federal Form 1040 of $251,244 for 2016. Now, there's 2 methods that are shown here, the percentage method and the weighted average method. So in addition to the percent method, residents may choose to use instead the weighted average method. The weighted average method is determined by calculating the weighted average of all monthly fees and all entry fees in the current year, and then multiplying by that percentage calculated earlier. Again, the amounts calculated for Shenandoah Valley, Westminster Canterbury in 2016 are listed here on the slide. 2 key points I want to stress before we move on, and that is, number 1, the deduction that is taken may not exceed the actual amount paid by the taxpayer in that tax year. And number 2, whatever method is used in the initial year, that method must be consistently used so long as the individual is a resident. And there we go. We can continue on.
Great. And
All right, terrific. Thank you for all of that so far. I'm going to pause for just a split second. This is Brian, and make sure I give that email address out again to make sure if you have any questions, you can get them submitted. That email address again is aguise@ebwllc.com. No question is silly, and all questions are considered. Let me just pick up here, and I'm going to give you a quick summary to everything that was just gone through technically. Don't do this by yourself. That's my summary. Make sure you use the help of a professional. There are some guidelines for how my screens will jump. Sorry, somehow my screens are moving all over the place. There you go. So bottom line is make sure you talk to the facility about getting the accurate information in order to determine the ratios, and then speak with a tax professional and probably your financial advisor to make sure this is something not only that it's worth doing, but that you're prepared in case the IRS decides that they're going to weigh in on some general cost analysis that comes from a private letter ruling. I do want to just state the following thing. If the IRS decides that it wants to rule on a reasonable cost that might be deductible, that would give us insight going forward. So that is not to say that anything will occur as a result of you taking said deductions, but you may have to make changes if the IRS ever passes a private letter ruling. That being said, let's move on to more of my portion of this, which is the planning opportunity that exists as a result of a move into one of these facilities and a sudden large offset to income. And two of them aren't listed. I'll give you those audibly here in a minute, but the first and most obvious one for a financial advisor is the opportunity to move money out of a retirement plan, either a 401k plan or an IRA, to a Roth account, and avoid recognizing income in that year because so much income has been written off, or to recognize a low level of income as to be able to move money at the lowest tax bracket out of the qualified plan into the Roth to grow tax-free into the future. Now that would grow for the entire life of yourself, and at present, unless the rules change, it would be eligible for stretch capabilities to the next generation. So it is an incredibly powerful planning tool should the opportunity arise to make a Roth conversion. And I think that needs to be studied on a case-by-case basis. Next is obviously in the year in which you take these deductions, your income is going to drop dramatically. And that's an opportunity for you to get a readjustment or recalculation on your Medicare premium, which could significantly reduce your Medicare premium for a few years. It won't stay in total, but it may be able to manage the premium going forward for at least a few years. Next is allowing for the sale of highly appreciated either property such as real estate or businesses, or even securities of concentrated stock positions that you've been holding on to because you haven't wanted to pay the tax. All of these opportunities now open up from a planning standpoint in your own personal financial plan. This may be the right time to do some of these things. The two that I haven't listed there, I don't know why they didn't come to my mind earlier because they're very legitimate, but they definitely depend upon your personal situation. Charitable contributions might be limited in the year in which you do this. Keep in mind you're writing off a significant portion of your income. So if you happen to give a certain amount of income every year, you might know that there's a rule that states you can give no more than 25% and deduct it from your income. Check with your tax accountant for this. But if your income goes down, but your giving stays the same, you may wind up with less deductible gifting than you had previously. And so you want to be conscious of your gifting strategy in the year that you would do such a transition in your life. And then lastly, you may be entitled to property tax relief if you still owned a property when the transition took place, if your income is reduced to a low enough amount. And that depends upon where you live, what county, what state, and so forth. But it is possible that sometimes senior citizens get relief on their property tax if their income falls below a certain level. I think this is probably a good place for me to kind of pause on this quote, which is from Omar Bradley. This is as true in everyday life as it is in battle. We are given one life, and the decision is ours whether to wait for circumstances to make up our mind or whether to act, and in acting, to live. So at this moment, I'm going to take some questions. One of the first questions I have is, are family members who are paying the entrance and monthly fees able to deduct these costs when filing? In essence, so you yourself are not paying, but rather family members are paying. And I think I'm going to turn that over to one of our other panelists for just a second and let him answer what you would need to do to figure out whether these might be deductible as a family member, and then I'll take it back after that.
And again, this is Dwayne Wernicke, again, CFO at Westminster Canterbury, and not offering, check this with your tax consultant, your tax expert, but typically the taxpayer, so it doesn't matter if it's a family member or a resident, but the taxpayer who pays the entry fee or pays the monthly fee on behalf of that resident should be able to claim the deduction in the year in which it's paid. Again, I don't believe that there is any requirement as to who is receiving the benefit of the payment being made. It's just the taxpayer that's actually making that payment. So to answer your question, that you need to consult with your tax advisor is, yes, I do believe that a family member may be able to deduct the entry fee or the monthly fee, the percentage or the portion thereof that is attributed to medical expenses.
I just want to add one clarifying fact. I think that you have to establish dependency. Once that's established, I think that could be the case. Again, check with your tax advisor.
Thank you.
Next, I want to point out another question that came in, which is, how many years or months ahead of time should I be looking through my options to be able to reach a solid conclusion about, making a change like this in our life? And I can just refer to my client who's been through the example, and maybe Leela, you can attest to other examples, but it took them over 2 years to make this decision, and they recommend a process of between 2 and 4 years before you come to a conclusion to make sure you've done your correct due diligence. What's your guidance, Leila, in that regard?
I think that's a great question, and thank you for bringing that to light, because it's gonna vary from person to person. But one of the most important things that I always try to point out is doing this sooner rather than later. One, because often you may not be able to enter a community you're considering if you are already in an advanced stage of need for health care. If you're needing assisted living or health care options, a continuing care retirement community may not be an option for you any longer. Whereas here, we generally only take admissions through independent living first. So that's a big point out for everyone to think sooner rather than later. I think a 2 to 4 year window is a good consideration, but it is going to vary from person to person. Residents say this all the time. They wish they would have done this sooner. So if you are even at the very early onset of your considerations now, even if it takes you 5 years, think of joining a wait list, because our communities are all getting full and staying full, and baby boomers are making that already begin to happen as well. Join a wait list. Don't even hesitate to start minimally downsizing, even if you're not going to make plans for quite a few years. I would say definitely start now, but 2 to 4 years is certainly a good window to consider as well.
Okay, next question is, how young is too young to make a change like this?
Another great question, and maybe that falls back to my previous answer. It's never too soon to at least start planning or considering the choices.
Maybe give us some sense of the type of ages you see and distribution in your facility. Maybe that'll be a good guideline.
Absolutely, absolutely. I will note that our minimum age to enter the community is 60, and you would want to probably ask that at other locations because that may vary, but that's roughly 60 to 65 what you'll find in continuing care communities as a minimum age. Here at Westminster Canterbury, our average age of entry is roughly 76, and community-wide, our average age through the whole continuum is mid-80s. We have a 62-year-old and we have a 103-year-old and everybody in between.
Okay.
So in terms of when to decide, it may just be a personal choice. Maybe you don't have children and you're really trying to protect your future because there aren't support systems otherwise. It may be a matter of just looking at the housing market and when's a great time to sell your house. There's a lot of variables, but certainly doing this on the sooner end than the later is going to give you the advantage of enjoying the community you're entering, not just paying for the care, but actually establishing those relationships that will be important through your life there, making new friends, joining clubs and activities and programs, and really being fully invested personally and financially in that community setting.
Okay, terrific. And if I heard you correctly earlier, one of the things you want to consider is that if your health is declining rapidly to the point of where you're debilitated, it's going to make this transition harder, if not impossible, right?
That is correct. Often you find that if you're at a point of scrambling and it's an urgent situation, your options are now very limited, and that may simply be that you can only have standalone nursing homes as a choice, and you're looking at those $7,000 to $8,000 to $10,000+ a month cost for that care. So it is important to really, again, be proactive versus reactive, because at that point, again, the choices are limited and you may not be in control of that decision any longer either. Someone else might have to make it for you.
Okay, great. And the last question I have here, and if you still have a question, please submit it. The last question I have here is, what if I have long-term care insurance already? I think that was partially touched on in the presentation. I want to reiterate a couple of things, and then maybe you can fill in whatever I leave out. If you have a long-term care contract, it generally will pay for unreimbursed expenses if you incur expenses in such a facility. So in most cases, you're looking probably at the Part B contract. If you choose this particular facility like Canterbury, Part B would wind up probably, you'd be able to collect some reimbursement from your insurance contract. So don't immediately cancel your contract. I want to make sure that it's very clear that you haven't lost everything from the contract that you actually have in place. As far as Part A, it may be, thank you, it may be that Part A and your contract shouldn't necessarily stand side by side, but I wouldn't just immediately default to that thought process. And you should speak not only to your financial advisor, but also the insurance specialist associated with your policy. Do you have anything to add there?
Brian, I think that really captured it well, that at least here in our community, long-term care insurance policies can still be used under the life care contract, that Type A. It would come as a direct reimbursement to the resident. We help with the process of filing claims and providing documentation of the services to qualify for your benefit. The modified care contract, Type B, really gives you the added bonus of a lower entrance fee on the front end if you feel you have a great policy to cover higher costs later. Definitely, I would encourage you not drop your policy, at least not immediately, until you've researched through that process more and how it could benefit you. Occasionally, people feel the premiums, which policyholders may know just keep going up and up and up, that maybe it's no longer worth it. They've not had it for a very long time and they have a low benefit, and they feel that the Type A contract almost serves as a long-term care insurance for them within the community they're living.
And Brian, the only thing that I would add to that too, that I just wanted to reiterate on the Type B contract, it does still contain an entry fee. It is lower than the Type A contract, but for Westminster Canterbury in 2016, 42% of the entry fee for a Type B contract was also deductible. The deduction is lower. The deduction is lower because the entry fee is lower, but still that you are still prepaying a portion of your future health care expenses.
Okay, terrific. I want to address the next question that came in, and I definitely have to turn this question to you because I really don't know the answer to this. I'm going to read it. It's a little bit long, so bear with me. Can you comment on taking advantage of filing for VA benefits and also for filing for Medicaid long-term care? For example, a mother who's 95 who's taking advantage of the VA and currently filing for Medicaid long-term care, is that person a candidate who might potentially be able to take advantage of either the facility and or any of the benefits?
Okay, I will back up a little bit and say, in terms of VA benefits, I'm not an expert in that realm, and the reason why it has been a long time since we've allowed direct admissions into our healthcare our health center here at Westminster Canterbury. However, Medicaid benefits, I do know, will supplement or pay for care in a health setting. And think of a health setting meaning nursing care. So in terms of assisted living, it's my understanding that Medicaid will not reimburse an individual for assisted living services. It's only when they qualify and or need nursing services and also meet the thresholds of the financial situation that they may be in. So if in this case it's a 95-year-old individual and they need nursing care, whether it's in our facility, Westminster Canterbury, which we do participate with Medicaid, or if it's in a health setting, then yes, they would file claims with Medicaid in order to reimburse for the services received. I hope that answers the question.
Yeah, and so I also want to point out, obviously, when somebody is not already in the facility, if they're obviously at the poverty level and collecting Medicaid, then to get into the facility would probably not, that's just not going to happen. But if you're already in and you're eligible for Medicaid for whatever reason, you run out of money and you qualify, then in that case, you're able to use the Medicaid, correct?
That is correct. In another instance, how they may enter our community or other communities within the nation is if they go to the hospital and they're there for 3 nights and they qualify for Medicare A skilled services. So if you enter a hospital for, you fall and break a hip, or you have a health condition that requires a stay, and they want to admit you into a senior care facility, a nursing facility, that's how we sometimes do receive residents that are on a Medicare A qualifying stay, but then after a certain period of time, they then kick over into a Medicaid facility or Medicaid reimbursed amount because they just aren't well enough to either return to their home or return to the assisted living facility from which they came.
Okay, thank you. Last question, and then I'll probably close. And this has been great. Lots of questions, lots of information. And if you have additional questions for your financial advisor, don't hesitate to reach out to your financial advisor about how this may fit into your financial plan. Last question, is there a source for the likelihood of different outcomes? For example, what's the probability that I will need nursing home? What's the probability that I will need a visiting nurse? What's the probability that I might develop dementia? And you guys are closer to this than I am. I know these statistics exist loosely. Do you have anything?
I think agree loosely, and you can certainly easily go online and probably pull up some of your own statistics. I do think that the Department of Health and Human Services quote that I entered earlier in the presentation, recognizing that over 70% of people need some form of these services, is pretty staggering, and the recognition that that's a high percentage of people that need any form of long-term care in their lifetime. It's not something maybe we all want to gamble on unless we had a crystal ball. So without that crystal ball, it's challenging. But at this point, I think that is a good resource, the Health and Human Resources website, maybe even under that cost of care study from Jen Worth. That might be a potential resource to tap into that has additional statistics beyond the cost structure. Those are 2 I would suggest, but certainly just general research online, pulling up those statistics might help.
Yeah, Brian, I've seen studies through different articles, whether it's in Wall Street Journal, Money Magazine, that have addressed those situations. What I sometimes tell folks is just look at your family genes. Mm-hmm. What has mom and dad gone through? What has brother, sister gone through? What's grandma and grandpa gone through? What type of health conditions have they had? In terms of corporation here for Westminster Canterbury, we do use an actuarial that is based on 30 years of resident data, us being on our 30th anniversary. So we have a pretty good picture in terms of a 65-year-old individual, whether male or female, entering our community, whether it's through independent living, assisted living, or healthcare, how long they're going to be with us, and how many years should they be in each center. So that allows us to prepare our budgets accordingly and for the future accordingly.
Okay, great. I will also add that we have a PDF of one particular client's journey, what they learned, what they went through, and what they suggest you consider if you're going to go through this process, and we can make that available to anybody who requests it. I want to thank everybody for attending today's webinar. I hope you found it as informative and interesting as I did, and we look forward to seeing you on our next webinar. I want to thank Layla and also drawing a blank on your name all of a sudden, Dwayne, for helping us today.
Yes, thank you so much, Brian, and again to your whole company for helping arrange this. We're very proud to be able to present to all of you listeners today. We certainly would be available to answer questions. If you'd like us to provide our emails to the firm, we are happy to do so. And again, thank you for setting this up. We're very happy to have been a part of it.
Thank you all. Good luck.
We will make this presentation available after this conclusion of today's webinar on our website in just a few days. And we'll make available also the contact information for Dwayne and Layla.
Great, thank you.
Thank you, everyone.